Here come the first rates then this Wednesday morning, 19,766 on Nifty, scaling up higher by nearly 0.5% for the Sensex as we speak. Once again, it's a better start for the broader end of the market. The mid and the small caps are the ones which are taking a lead over what the benchmarks are doing. Let's first revisit the big buzzers from yesterday. Everything from a Coal India to Adani Ports, Bharti, Hindalco, Adani Enterprises, Tata Motors, these were your top performers in trade yesterday, as was the case with realty names as well. The likes of a DLF, Godrej Properties really leading the charts when it came to the Nifty Realty Index. And today as well, you are seeing good amount of traction for the Realty Pack as we speak right now. What's Escorts up to, what's City Union Bank up to, and NMDC, those stocks also will just come up for you on your screens. Now let's address the newsmakers. MCX, and they're going to go live on the new platform come October 16th. So let's see what that stock is up to. CUB, of course, is seeing a big move after that mega move in trade yesterday, and MCX as well. There's really no stopping this one. Another 2% higher for MCX as we speak right now. There's Ugro Capital, a good amount of AUM addition in the quarterly update, a 73% uptick. Net loan origination has risen about 34%. Ugro gaps up 5% as we speak right now. NCL as well. The production numbers for cement and the dispatches as well, both have posted a good show. So both those stocks are looking quite okay in trade as we speak right now. There's Religare, which is in focus. There's Lakshmi Organics, wherein there is a 259 odd crore rupee QIP. There's of course BOB. Let's see what that one is doing, considering the RBI has now barred the onboarding of new customers onto their app BOB World. So that's another stock which is in focus. And Cipla, we already told you about this, but now newspapers are catching on to that story that the valuation is where it's all getting stuck when it comes to, deal pricing for Cipla promoter stake sale. There's of course Z as well, wherein IDBI trusteeship has filed an appeal in the NCLAT against the NCLT nod for Z-Sony merger. So that, news flow really continues on this one. But Z is unabated. All the damage, I think, is already in the price. 261 is where that stock is currently in trade. Ajay, anything in specific that you're spotting?
I'm looking at a follow-up buying which is happening in a lot of Mumbai-based real estate developers like Sunteck and others. I'm also looking at some of the, all these Varun Beverages of the world, Zomatos of the world. So that entire QSR / eating out / so that kind of merry-making stocks are also doing very well. So the early rates actually appear that yesterday's gains are maintained. We need to see first 15-20 minutes, very important, that do we give up some of the gains which were made yesterday or we build upon them. That is something to watch out for. And yesterday pharma was weak actually, particularly weak. Today pharma has come back. Stocks like Dr. Reddy's are doing very well, and so is Lupin. Both are trading by 1 or 2% higher. So overall it looks like a pretty decent opening this morning as well.
It does. Kunal, how's it looking for you?
It's a very good opening for the indices. The Nifty back again about that or closer to that 19,800 mark, and the Bank Nifty above 44,500 mark. I think this could be a standout feature for the markets, that hopefully the banking stocks would now start to get realigned as well as start to get into an outperforming zone. And within the banking pack, ICICI Bank is something which looks very attractive, and that's a stock which I'll pick for the opening trade.
Okay, ICICI Bank, that's the first pick coming in from Kunal, and that's a buy call coming in from him as we open trade. Naresh, what are the first stocks that you're punching trades on? Naresh, you got to unmute yourself.
Looking at CRISIL on dips to buy for the short term.
All right, there you have it. Those are some strategies that our chartists are betting on. Okay, let's connect then with Ajay Srivastava as well, who's joining in on the show. Hi Ajay, good to have you on board. And we're talking about the Nifty reclaiming that 20K mark at a time when the global fears are surrounding us. Do you think that the world markets at large and even our own markets are largely remaining insulated from a lot of those fears?
See, our market insulation oscillations comes from the fact that the Indian investor is still in the buying mode. It's not in the selling mode. And I think that's a fundamental difference that we need to account for, that yes, there are global events which we need to be wary of, but the fact remains that Indian retail public, HNIs, are net buyers in the market. They're not selling, they're using every correction opportunity to buy into. So unless there is a dramatic reversal in the feeling, domestic market, investors that we need to sell, I think we are in a little bit of happier ground. Plus, remember this always, festive season gives you the extra cheer. When you feel good about life, you need to buy stocks. When you feel bad about life, you sell the stocks. I think as you go into Diwali and Durga Puja, Diwali, Christmas put together, not only India, globally, you are in this phase of the market. So I think purely from a standpoint of sentimental, upliftment, it's right there. We're in the festive season. Surprised that Hamas thing did not affect the market, but then the Fed did its role in terms of the interest rate that they said that we might have to cap it now at this rate. So all in all, I think we have a good festive season ahead. So positive sentiment to your portfolio, positive sentiment to your life.
Yes, it is. Not a positive sentiment. If you're looking to buy houses, we get reports, Ajay, that, I mean, forget what the stocks are doing, but realty prices, at least in Delhi and NCR, escalating and spiraling up with, quite a bit of speed. In Mumbai, in any case, it's all premium property through and through. But tell me, is there still money to be made when it comes to realty stocks? Because they're already at a 15-year high, the index.
See, reality stocks have a two-way component. One, of course, is, I'm going to tell you a joke about this one of the largest real estate companies, MD told me that, and they have a garment business as well, that it's easier to sell a 2 crore house than a 20,000 rupee jacket in this country. And which tells you the story right now, that there is a frenzy out there in the market. And when you buy into a frenzy, you will pay for it. And I think people who are buying real estate today, or you buying into real estate companies, except, and I'll come back to that, are not going to get the best possible return. You can get a short-term return, but definitely not from this way, because you're buying a real estate company at the land rates of today, hoping that you will make a 20% plus return on your portfolio in the next 5 years. Now that takes it, the property prices need to double really to give you that kind of return. I don't think that's going to happen at all. Unless you have something like a company like a North Indian diversified company, which has got rental yields coming into the portfolio in a significant way. I think those are the ones which will gain in the end because annuity income comes in. Unlike a pure play companies which are standalone, that they sell the houses and they book the profit and they go away. So I would rather bet on real estate where good annuity incomes from commercial and properties coming, office properties, than just pure play, just the housing kind of companies. So pick your choice, but it's going to be very difficult for real estate companies to beat the market returns in the next 3 years from where they stand today.
Very, very interesting. You have a very differentiated view, Ajay. Despite, on the one hand, we are reading, today's ET says there's a deal in Camellia which has happened, 10,000 square feet apartment sold for over 100 crore. That amount of money is actually flowing into realty. But you are actually saying the non-sexy part of the real estate, which is perhaps REIT, InvIT, which are very good HNI and family office kind of instruments, give you 6-7% on an annuity, and you top it up a bit of capital appreciation also if you hold it for 10 years. Which is your favorite one out of the three? Embassy, there is Next, there's one, IRB InvIT is there. Which one do you have in your portfolio?
I have not in a portfolio. I have the REIT, which I have is integrated actually as the largest component. And the reason I tell you why I don't have in the portfolio, because each of the guys who sponsored overpaid when they bought this portfolio. There was a frenzy of putting money on the table, and therefore you see that the market prices have crashed of the REITs, had down by about 25%. So therefore, so unlike, let's take a North-based real estate company which owned these assets, has leasing it out, is actively involved. These were private equity funds who had new biscuits coming in, buying at the highest prices, don't have a clue how to rent the properties, and therefore the real estate REITs in India have been the worst performers among all compared to even any other. So, unfortunately, Indian experience has been bad on REITs. I was more referring to companies which have large annuity incomes in terms of their commercial portfolios. REITs in India, I told you, run by private equity funds, and guess what, Ajay? I'm telling you, they all want to sell out today. They know they bought a lemon, they mismanaged it, their NAVs are down, and now they want to exit and there is no exit available. So I would not touch the REITs of real estate at this point of time because the primary investors itself want to exit a bad investment.
Okay, fair enough. That's your take on the entire real estate space. And autos really have been in top gear. Ajay, what's your outlook? They're talking about how the premium end as well is doing very well. What's the expectation when it comes to the festive season? Would this be a good space to bet on?
Oh, of course, it's going to be a good season. I think, India's upper tier consumption story is absolutely intact. It's the lower end 70%, which is a problem. The top 5% doing well. I live in the same complex you mentioned, the camellias, which is prices are going berserk. There is no bar, Ajay, on buying stupid. That in the world, a lot of people, money is lost. You saw SoftBank, right? Buying atrocious prices, but that's okay. Somebody's got too much of money, doesn't care about 100 crore. That's fine with that. But the point still remains that the upper tier of India is earning well. The wealth is increasing at this point of time. And just remember one thing: the reason upper tier is doing well is that we got a big tax cut in this corporate market, which became 25%. So while I pay a 42% tax, a company earning 5,000 crore only pays 25% tax. Now, all that benefit of tax has now gone to the promoters and the HNI and to the corporate market, stock market as well. So remember this, and now if you set up a new company, the tax rate is 15% for manufacturing companies compared to 42% individual income. So upper tier business families, industrial families, stock market owners are all gaining at this point of time. No reason for upper tier consumption story. Five-star hotels, you've seen what's happening there. Travel, you've seen what's happening there. You've seen the remittances abroad going absolutely skyrocketing. So upper tier India, perfect shape, will going to spend money, and there's no problem at all. If you're betting on the economy end, I think that's where the problem is and the pain is.
Quite interesting. Ajay, what do you then do within the rest of the market? I mean, what is it that you actually avoid at this point? Anywhere you feel that the valuations are exuberant and have run up ahead of the fundamentals?
No, I think we just need to keep away from chemicals for the time being. I think they're too overpriced given the market conditions. That's some sector we're not going to be in. I think we are almost out of pharmaceutical at this point of time. The run-up, pharmaceutical run-up happens actually once in 5 years, and that run-up has already happened. I think by and large, the story has played out for a superior return. And remember this, our threshold also has gone up, because if I'm getting 9% or 12% in fixed income with almost negligible risk, I need to find stocks to give me 18% plus return in the next 3 years. Therefore, I don't see chemicals as a story which will give me that kind of return. I don't think pharma is a story which is going. We have returning back to a little bit on the banking space, not the NBFC, but banking space. I think we're going to be there right now. Capital goods, fantastic story. Don't worry about it. Defense, lovely story, because there is no supply of stock coming there. There's more demand of stock. And I think, if I'm not wrong, one mutual fund has it that you can't buy bulk, a defense sectoral fund. You can only buy in SIPs, which tells you that there's paucity of supply of paper in the industry. So I think capital good, the defense, I think there is a reorientation of companies who are launching in paint business. Wonderful. One sector I will do not buy, and I will not buy, is low-end consumer and retailing sector. Poorly performing companies, poorly performing returns, including our largest company in India. That sector I'm avoiding totally. So I think consumer retailing is absolutely zero. It's out at this point of time. And chemicals hold, pharma out. That's the way we are watching. Capital goods continue, defense continue, hotels love it.
Ajay, I want to understand, there was a very quiet re-rating of the entire legacy power companies, REC, even lenders, REC, PFC, NTPC came at a 13-year high, Power Grid too. Did you manage to catch on to any of the entire power value chain, kind of re-rating which happened, power cables, transformers, all of that?
Well, God has been kind. We managed to catch up REC, PFC, because if you remember, their valuation was, again, this is the point. The valuation was in absolutely dumps. The yields were 12% on dividend. We didn't expect, to be honest, Ajay, that they will fly like this. But when the yield is 12% on the PFC kind of thing, where all the loans are tenors of 10, 12 years and interest rates are going higher, it was a sure bet. I think we've got that. I think we have in our portfolio, if very early in the game was something like Tata Power, because that's a one company which works both ways. It has power and coal. So I'm not recommending a buy or anything. I'm just explaining to you that why we chose one of the companies is because if it, coal prices went up, the power profit went down, but the coal prices gave the lift, ballast. And when the other way happened, the power company gave the ballast. So I think it's a very well-balanced portfolio at this point of time. power will remain a great story. And I think now that the government has realized that, renewable power can only do so much, finally the legitimacy to old thermal power companies, and that is what has seen the re-rating, whether it's NTPC, whether it is this thing, that finally the government of the day is saying, I'm going to encourage thermal power. So far, the story was, we're going to discourage thermal power. So the new guys will come and beat you up and you will not get approvals and environment will be an issue. Ever since last 1.5 years, that policy has changed. I think that's when the re-rating started. And I think the story is there for people to continue. We are still at a very nascent stage of power. But remember this always, that it's a government price controlled industry. So you will have ups and downs, but the asset they are creating is going to be hugely valuable. With inflation at 8-10%, these are going to give you very good returns over time, because you can't set up power plants overnight, and the new ones are really expensive. So it's a good story, sensible story, but it's not a mega story which will give you a three-bagger.
Ajay, a quick follow-up regarding wires and cables. I mean, earlier there were just two companies. Polycab today makes, when it got listed actually, that entire year's profit, now they are making on a quarterly basis. But that story played out. It's not 60-70 times. KEI as well. RR Kabel is, I mean, the story is very good. Are you touching them because of, or is it like prohibitive because of valuation? The entire wires and cable play.
See, it's a very good industry, to be honest, because we got so much of more runway left in the industry to kind of demand side. We have rarely 5-10% of what the economy needs in effect. Can you imagine if we need to house 100 million people, the kind of requirement which will come into the system at some point, maybe a year, 2 years down the line. So on a pure demand trajectory, they are wonderful. The only thing is competition going up and the valuations are absolutely nutty, if I may say so. So therefore, we kept away. Not having said people bought, did not make a return on it, but I do not understand how you make returns in a normal commodity product industry with the P's of above 50. It has happened, market has given, market has its own rationale, but I am not a buyer in a company which is doing commodity products by and large at a P's of 50 and above. Demand side, I don't see an issue. Valuation, as you raised, absolutely an issue. And there are so many more better candidates which have got monopoly status in this country, where you want to put your money. You don't have unlimited capital at the end of the day. So you need to find places to put the money where companies have got monopoly status. And I think India has so many of them now that you just need more money every day. I wake up and says, where I'm going to find more money from?
Especially if you want to hook yourself up with a ticket for the World Cup. You're also playing nutty prices for that. Have you managed to do that?
Oh, I'm not a cricket fan. I'm so sorry to disappoint you. I am not a cricket fan. I don't like sports which only 5 countries play. So ask me about Football World Cup, yes, I'm going, but not the cricket one.
Okay.
I think we need to get more countries to come and play cricket. We can't beat up Afghanistan and be happy about it.
Also the likes of Australia, etc. But okay, point taken. We'll chat with you when it comes to football prices. But, speaking of nutty valuations, I just thought I'd get in your thoughts on what's going on within the entire pharma space as well. Are you being, a little bit selective, or even betting on themes that could actually benefit from the Cricket World Cup? How about we get in your take on that? Say hospitality, aviation, etc., or even food delivery companies.
Okay, I have all three. I have all three there. Absolutely, you nailed it. You should be a portfolio manager instead of an anchor. Believe me, you'll do much better. I'm telling you this one. It's absolutely what you said. Upper tier India, travel, hotels. Okay, you need to take planes to fly. 2 companies who do the whole work for India. Beautiful setup. You need a delivery companies. One is listed, one is not listed. Now, how much brains do you need to actually do investment in that kind of company? And guess what? And it's, what the amazing part is, people looking at delivery. But if you go down the business model, the advertising has become a big business model. The delivery will become, in 3 years' time, delivery will become very small part of the revenue. Advertising will become biggest part of the revenue, because not many people know this, that when you subscribe to these services, the kind of discounts you get on hotel is outrageous. You pay 150 quarterly subscription, you go to 5-star hotel, you get a $9,000 discount. That whole model of subscribing to their services and advertising on their platform, I think will far exceed on the delivery what is happening there. So I think it's a great story for India. It's just started. People who, yeah, sure, if the price was 50 rupees, now it's 100 rupees, so you may feel cheated, you left out. But don't look at it this way. Look at the fact that 5 years down the line, what are these companies going to look like? Mega money-making machines these companies are. So absolutely correct. Aviation, and not for short-term, long-term, hotels continue to good story. Food deliveries, yes. QSR, I'm not very confident because so much competition in QSR today. You walk into a mall, there's some 40 outlets all churning out, rubber and kind of cardboard sounding burgers or tasting burgers. So I'm not so sure about QSR, but I'm certainly sure of home delivery companies. I think do a better job for your portfolio.
Ajay, in case you don't like cricket, I'm sure you do like Bollywood, right? The other religion. It's Amitabh Bachchan's 81st birthday today. But tell me, who's the Amitabh Bachchan of the stock markets? I mean, erstwhile it would be HDFC Bank, given its last one-year performance. Maybe that's getting a little challenged. But who's the big B of stocks?
Yeah, big B of stocks. I think, no, come on. Amitabh Bachchan had also one or two competitions, but he survived the longest. So I would say the trilogy, if you ask me, of the companies on this online commerce, I think are the stars for tomorrow. And I think there will be a time when each of them come and says, not like Amitabh Bachchan when the Shah Rukh Khan, we told you so.
That, Ajay, always good chatting with you. And I must say, ever since you disclosed that you live in Camellia, you're the chatter in the newsroom.
I live in Magnolia. Surrey correction is next door to Camellia, the same
yes,
complex.
it is. Yes, it is.
I'm the cheaper version of what Ajay's high net worth is.
Ajay, would you want to say anything to that?
Well, I would talk about that in that direction, but I'm in Delhi, Ajay. By the way, I'll reach out to you. We should.
Oh sure. Let's have a drink. Yes.
Over a coffee or
at his place.
We don't have coffee in Gurgaon,
right?
No, we have only alcoholic beverage supporting our investments in those companies.
Great chatting, Ajay. Thanks very much.
Thank you very much.
For your time
have a good
today.
day.
But I was just thinking, Aisha, at 81, all of us professionals working in business journalism or even investors, there's a ton of stuff which all of us can take inspiration from Amitabh Bachchan. Longevity of his profession, despite ups and downs in net worth, in career, as well as health, he bounces back and fights back. Works very long hours along different genres, ages of colleagues and languages. And look at how he's actually shining bright even at 81. I was just thinking about it. But let's move on and put the spotlight on the...
He rises from the ashes each time, post that Miss World debacle, ABCL, AB Corp, getting bankrupt. And from there, then his return to KBC. And, since then, there's never been any looking back. Those, by the way, Ajay, you're not in Mumbai, but those are the early morning visuals. He was right there at his home in Jalsa, greeting all the fans who always queue up every Sunday and on his birthday to just get a glimpse of their mega superstar.
And look at him, not looking, the age that, really proving that age is just a number. Fans thronging as always. So, Ajay, are we going to see an 80-year-old Ajay Sharma on ET now?
Well, not on ET now, but I'll be around stock markets.
I'm sure you
that
will.
Kind. Because, this is investing is a game you get better right after 50. The first billion Buffett made was at 51.
At 60.
And then, of course, the juggernaut rolls. Let's take the discussion forward with a company which has made a lot of money for investors who held on, and that is, Minda. Look at the returns. The stock has actually added a lot of value if you look at the long-term chart. Right now, it is in focus because there are certain OEMs, auto companies, which have already started implementing 6 airbags in their bigger version of the cars. And the word on the street is that it's only about time. The industry wouldn't really wait for regulation from the government side. They'll be proactive, and the direction the industry will actually take is higher airbags as far as the bigger version of passenger cars are concerned. This is one company which has exposure in the airbag segment, and we are joined by the management now, who is joining us now. Thank you very much for joining us, sir. Talk to us about the way airbag consumption in an average passenger car, the direction it is actually taking, and what is the global average, if you could just share.
Yeah. So Good morning, Ajay, and good morning, friends. So, in terms of the airbags, we all know that government, in its endeavor to strengthen the passenger safety at the top of its mind, has earlier mandated the 6 airbags mandatory, which recently has been sort of submerged into the Bharat NCAP rating. So, the rating of the car will be done as per the airbags or the safety systems of the entire vehicle which is there. So, earlier, if you see in India, normally, if you go a couple of decades back, the airbag used to be only in the luxury segment cars. Now, today, you see that even the A segment, B segment cars are anyway coming up with at least 2 airbags, which is the driver and the co-passenger. And since last 1 year, I think a lot of OEMs have been proactive in increasing number of airbags. So if you see today, cars are anywhere ranging from 4 airbags to somewhere around 8 airbags in the luxury segment or the top end of the car. Globally, if you see, 4 airbags is something which is a sort of a mandate. You will find on an average 4 airbags in a car, and gradually the direction we are moving towards, we will see the same trend in India as well. And this with the Bharat NCAP rating there, and like we have for power, like 1 star, 2 star, 5 star rating, same way you will have the safety ratings also, and let the consumer decide as to what he is comfortable with in terms of the safety of the vehicle by the rating. So that's the trajectory we are looking at, from a low-end car, which is A segment, B segment, of 2 airbags to maybe 4 to 6 airbags in the near future.
Right. So just to understand then from you, how much do airbags overall contribute to your revenue? And do you see now with, all that you spoke of, this revenue contribution to the overall pie increasing?
Yeah. So if we see in terms of our business, the way it is structured, so the airbag business is with one of our joint venture partner, and the as per whatever the accounting standards are, the revenue from the airbag doesn't form part of our consolidated revenues. But if we see from independently, the revenues from airbag business currently is around 500-600 crores. We are investing 150 crores in expanding our airbag plant at Nimrana, and we are looking at our airbag revenue in the near future expanding to 1,500 crores kind of a range in next 3 to 4 years.
Right. The segments that did well for you, and I'm just purely going by the first quarter trend, was sensors, controllers, and EV parts. Clearly, one is seeing increased usage of these in cars, right, nowadays. How do you see an increase in penetration in these segments? And are we still import dependent when it comes to some of these parts?
So sensors are largely now domestically produced. In fact, we have been consistently increasing our sensor business. We have guided sensor and controller business to be around 500-600 crores over 5 years, but we have achieved that in, I think, between 3 and 4 years average kind of a range. So our sensor controller business is much more than what we have guided today. The localization in sensors has been really nice over last few years, but still there are some critical sensors which are being imported. But if we see from the EV part ecosystem, you mentioned that the second segment. So there are more than 250, 300 kind of OEMs which are there in the country. So people are having small facilities. They are importing the parts, assembling and selling the two-wheeler or a three-wheeler segment. So still there are a lot of players who are doing cheaper imports. But with the government incentive policy, be it PLI or FAME incentive, which mandates minimum 50% domestic GVA, this will definitely force people to source locally. And there is a huge opportunity to localize the entire ecosystem of EV products. And as you know that we have been speaking to you also, that the kind of ecosystem we have built or the product profile we have built for EV is unparalleled in the industry. So we have a very wide variety of EV product, but definitely it again boils down to what is the customer strategy in terms of what he wants to do in-house or what he wants to outsource. But we definitely have a very, very wide product portfolio from an EV system, and there is a huge scope for growth in the near future.
Mm-hmm. Sunil, you were talking about increasing your business from sensors. That brings me, I was just thinking the other day, over the years, Indian automobile manufacturers are witnessing a very sharp surge in electronification. Small things which are run by electronics and sensors and battery run stuff in a premium car, say 10, 15 years back, is now available in a average, starting end car. And we are only seeing that going up. Have you looked at what kind of composition of your business is actually coming from more electronification of an average car?
In fact, Ajay ji, the more and more business we are adding, if you exclude the alloy wheel part or the aluminum part, the large addition is primarily on the electronic side. Now, it is, while sensors definitely are increasing, I take an example like, as you rightly mentioned, 5 years, so 10 years, 15 years back, maybe a small tire pressure sensor or a rain sensor or a light sensor used to be luxury. Now today it's in a basic car, right? But if you see from electronic segment, we always say that the car, which was a mechanical instrument, now is getting more into electronics heavy than mechanicals, like electromechanical equipment. So you see a lot of things are getting into electronics, be it in addition to sensors, you see a lot of electronics are coming into the central console, the switches, which were the lever-based switches, now getting into touch-based switches. There are a lot of electronics which are built in, ambient lighting, the LED lighting. So the cost of electronic component in the vehicle has been actually increasing by the day, and you are 100% right. The electronics value in a vehicle, even in our businesses, has been increasing significantly over the last few years, and we expect this trend to even continue.
What about the updates then on the four-wheeler switch plants in Chennai and Farrukhnagar? Can you just update us in terms of how they could potentially help your overall top line?
Yeah, so we have been expanding, as you rightly mentioned, the plant in Chennai because we are facing space constraints. The business has been doing really well. The expansion, definitely we are expecting to add revenues of almost 250 to 300 crore per year. In terms of Farrukhnagar expansion, so what our strategy is that we don't want multiple plants in the same location, right? Because it increases to cost, you're not able to take the benefit of operating leverage, etc. So we do have a current plant in Gurgaon, which is in Manesar, and we are facing space constraint there. So Farrukhnagar is just like 15 kilometers ahead from our existing plant, and we are building a much bigger plant. So our strategy is, even the existing plant gradually moves out there. And in terms of capacity, we are working to double or triple that capacity over the next 8 to 10 years. That's the kind of flexibility we are building at the new location, so that it is easily sort of able to meet the demand for next 10 to 15 years of growth.
Okay, good to have you on board. Thank you so much for taking time out and joining in, giving us more perspective on the overall business. All right, let's quickly check in on what the market is up to at the current juncture, holding out around the 19,800 mark. And on that note, we'll take a quick break with news that the broader markets are outperforming.
It is perfect bachelor pad.
तो कब लेना है आपको?
अरे पहले बैचलर तो बन जाने दीजिए। डिवोर्स की फाइल घूम रही है कोर्ट में।
मतलब अभी नहीं खरीदना है?
अरे अभी खरीद लिया तो ये घर भी उस फाइल में अटैच रहेगा। समझ रहे हैं ना आप?
इसलिए housing.com का हाउसिंग असिस्ट फॉर रेडी प्राइस मैच एंड वेरीफाइड बायर्स. housing.com, पोस्ट योर प्रॉपर्टी नाउ.
All right, so TCS is in focus because of the buyback, the 60,000 crore cash which is sitting on their books. Soumit is here with more on that. Soumit?
Well, for TCS, if you see along with the earnings, buyback is one thing that investors would be keenly watching out for. Now, this will be the company's fifth buyback. In the last 4 buybacks, the amount was close to anywhere between 16 to 18,000 crore rupees, and the company has usually deployed nearly 1/3 of their cash on books at that time for the buyback purpose. Now, the buyback price at that time was at a premium of around 18% to the market price back then, and the retail acceptance ratio is one thing that one needs to watch out for. Now, for the first 3 buybacks that TCS had done, the retail acceptance ratio was close to around 100%, but in the last buyback that happened in 2022, the retail acceptance ratio, now that came down to just 24%. Now, if you see currently the company could have a cash of around 60,000 crore rupees on its book, assuming that 1/3 of this is used for buyback, the total buyback size could be anywhere could be close to 20,000 crore rupees. Now, assuming that the company does the buyback at a premium of around 18%, then the buyback price for of TCS could be anywhere between 4,300 to 4,400 rupees per share, which means that the company would buy back nearly 1.1% of the total capital. Now, but what's in it for retail shareholders? Now, if you see in the last buyback, the acceptance ratio had come down to nearly 24%. If that continues to remain the trend even in this buyback, then the actual gain for any retail investor would be much lower, because even if we assume that the buyback is done at a 20% premium to the current market price, the retail acceptance ratio is just 25%, and the actual gain for any retail investor would be just 5%. over a period of nearly 2 to 3 months. So retail investors might not gain much from TCS buyback if the acceptance ratio continues to remain on the lower side in the buyback.
Okay, that's one side of it, perhaps the bigger trigger, but the other one, of course, is earnings as well. Let me take it across to Anisha, find out what a poll is penciling in.
Well, yes, IT bellwether TCS is going to kickstart the earnings season for Q2 FY24, but the expectations are fairly muted from the counter. We are working with the growth expectation for around 0.6% on the top line, both in terms of dollar revenue as well as the constant currency revenue as well. The rupee revenue is expected to be upwards of around 60,000 odd crores. That's where there would be a growth of around 1.3% there. Last quarter, that is in Q1, the company had taken the impact of wage hike for a large part of their employees. So on a sequential basis, there will be an improvement because in Q2, there will be productivity gains, efficiencies, as well as the lack of the wage hikes. And that's the reason Q2 is expected to see a bit of a bump up as far as margin is concerned. By 30 to 50 basis point is what we are penciling in. The profitability, however, is expected to remain flat around at 11,100 crore thereabouts. Now, in terms of the other internals, deal bookings is something which would be very good for the company. Of course, in the quarter gone by, we have heard a slew of bookings that the company has done, whether it was BSNL or the tie-up coming in for Jaguar Land Rover and the other companies as well. So, on account of that, expect the deal win momentum to be close to around $9 to $10 billion at least. And of course, the other things to watch out for will be if there's any further strategy change coming in. Headcount trend is one thing to watch out for. Over the last couple of quarters, seen a decline in the headcount. Whether that continues, there were reports that the company is shifting away from the hybrid model to completely from office. That is also something that the street would want more details on. Of course, the commentary in terms of how demand is panning out, is it incrementally positive or the status quo really remains? UK, America, BFSI, these are the key verticals. The updates on that will be important. And of course, the all-important buyback, which is going to be one of the big talking points this earnings season for TCS at least. The street is working with a buyback of around 18,000 to 20,000 odd crore. Premium is expected between 15 to 20% if you go by the historic averages. But of course, the acceptance ratio hasn't been that exciting for the retail shareholders. That's why we had seen tempered move after this announcement as well. But nonetheless, this is something to watch out for.
Indeed, it is. That and lots more. Let's connect with Omkar Tangsale, who's now joining in to give us his view on the entire IT sector and earnings. And let's just take forward from that point that Anisha was flagging off. An 18 to 20,000 crore rupee buyback is what the street is penciling in. What's the outlook on the overall acceptance ratio? How do you believe that the street is likely to read into the buyback announcement?
Yes, definitely. I mean, TCS is always announced in that particular range of 16,000 crores to 20,000 crores. So the major thinking of issuing the buyback or special dividend is like transferring 80% of the cash flows or to the investor side. So I believe it's more of attracting the investors to the company's performance. But I also believe that the company looks to be very confident in terms of going ahead, as backed by the strong deal wins, the demand that is coming up for the generative and newer technologies like machine learning and all across sectors. Yes, definitely there are some near-term challenges which likely to persist, but I believe it's long-term good bet. I believe it's more of a positive sign in terms of TCS, so market should react positively with the price. We are expecting around 4200, which is 15% with open market. They're going to buy, but see, one should be expecting how it's going to be.
All right, that's a view coming in on the overall share buyback. But the street is also going to watch out for a number of things in terms of the strategy transition under the new CEO. What is it that you're expecting by way of the overall headline number? Will it remain flat? And do you think that, a flat number would be preferred by the stock markets rather than a bigger disappointment this time around?
No, I don't think there will be a bigger disappointment because I believe TCS is more of an executioner and performs well of execution. We are expecting around 0.7% of the CC revenue growth and 1.5% of the growth in the rupee terms. We are expecting expansion of the margins by around 80 basis points at 24%. So we are expecting because of the easing out of the salary wage hikes and decrease of the on-site expenses and subcontracting costs. So that will be affecting positively on the TCS margin side. But overall, I mean, the revenue growth momentum is likely to be remain tepid and not going to be a stronger in terms of getting the momentum back on the track. The recovery will still likely to be there, and it will take some more time as than expected.
Omkar, how do you see the valuations, purely the valuation call on TCS, say, compared to few others?
Yes, definitely. I mean, TCS has always been a premium. You know why? Because of the three reasons that the margins are exceptionally, because it grows with the volume, the return on equity is higher as compared to other peers of Infosys, and again, I mean, uh, the all. In terms of all perspective, it grows with the volume. If you can also see the TCS is having the highest margin, and secondly is with the Infosys, thirdly with the Centec, and fourth with the Wipro and TechM. That is the ratio. It grows with volume. So it's always having the better operating margins, return on equity, and return on capital employed. So its valuation is going to be premium. But I believe it's now it's been reduced from the upside levels, and if investor is looking from a long term perspective, then it is a safer bet to position along with for a longer run horizon.
Omkar, for us to say that, IT and in TCS in particular is safely out of the woods, I get some of the key monitorables are going to be very important from the management commentary and the numbers this time, right? And I'm just looking at your note itself. What they have to say about the client spend, especially in the BFSI vertical, I think that's going to be a very big signal. Pricing pressure on realizations, the rising subcontractor costs. What is your expectation at large about these monitorables and what the commentary is going to be around these?
I mean, definitely there will be a cautious commentary in terms of verticals. The VBS, I don't think. I mean, there will be a spending delays will be building on, and people started investing again back into the automation thing. I believe it's few for more quarters that one can see more of a cost optimization, and will likely to persist even for the next couple of quarters. But definitely we can see a recovery. In the last call of the management said that we have the month on month visibility on the sectors currently, which likely to be turning out to be positive side going ahead. H2 will be a comfortable. I mean, one can look at some part of the recovery. I'm not saying it will be a larger recovery or quicker recovery, but definitely there will be some recovery and some visibility. But definitely, I mean, one should see what is management is saying upon the client spend, especially from the North America, and that is from the BFSI vertical, because that is a major contributor to the top line.
Gar, for joining in and sharing with us your analysis on the IT space. TCS laying low prior to its earnings, 36-37, and for the most part though, IT is holding out in the green, much like the rest of the market. We'll take a very short break and be right back.
Hotel. Doing well. There's one particular stock which is doing quite well in today's trading session, and that is Ugro Capital. Well, the trigger this morning is the second quarter business update that the company has actually shared. Stock is gaining higher by 5%. The AUM growth has gone up 12% on a sequential basis, which translates to almost 75% growth on a yearly basis. Where is this explosive growth coming from? Let's Sachindranath, who's also joining us now, the management, the MD CEO of Ugro Capital. Sachindranath, very good morning. Thank you very much for your time. Where is this massively explosive growth coming from?
Ajay, as I've been saying for a few quarters now, that Ugro, which set up its base in 2018, it used the downtime of COVID to build massive infrastructure. It has grown from 120 people to almost 1800 plus people, 9 location to 100 plus location. Our digital technology infrastructure went from 5 people to 275 people. Now, so that base is maturing. And as we have said that in March, we reached to roughly around 60% of our installed capacity. We did almost 500 crore of monthly run rate in March of current year. And we planned that we'll maintain that run rate for the whole year, and gradually by every month it would keep increasing a little bit. So actually, it is just coming to that. I would say that the early effort of putting one of India's largest digital plus physical infrastructure for small business financing for customer segment of 25 lakh turnover to 10 crore turnover is playing out well for us.
Just a quick follow-up. I want to understand what is the mix looking like? What is the client mix? What sectors are they coming from? Or do you have exposure to one particular sector higher than others? Or have you distributed that risk very well?
No. So we look at this segment of small business customer, which is 25 lakh to 10 crore turnover. We look through the lens of obviously the machine, what we call the Grow score. When we use GST banking and the bureau, and there is an algorithmic method to we score our customers and say yes and no. Under that, we have decided or we have designed our business to be focused on 9 sectors and 100 sector. So which is healthcare, education, largely India's consumption market. And our portfolio are spread across these sectors. So there is no one single sector which is actually contributing more. And third, we look at by the customer need and the product type. So as you know that we do secured prime customer in top 25 locations, we do micro enterprises in 75 locations, we do productive asset machinery financing, we have now entered into the renewable and solar rooftop space. We are expanding actually quite rapidly into what we call solving the problem of credit for the retailers in India, which is linked to large ecosystem. So our digital merchant lending app is also now gradually started picking up. So it is across our 9 sectors, across our 150 plus subsectors, across geographies and across product line. So I think so we are becoming a prominent force to solve the problem of credit for this customer segment.
Sachendra, I mean, can we expect you to achieve an AUM of, say, 20,000 crore in the next 6 quarters? Is that a fair assumption?
Well, we have been, very, very open about what our long-term aspirations are. I've been constantly advised that no listed company should give forward numbers so aggressively. But I think so, we should be in that range for sure. The way you should look at it is that we started April at 500 crore monthly run rate. We exited at 6,000 odd crore. You add our 6 to 7,000 crore of disbursement, and that's why we should be between 9 to 10,000 crore this year. Our natural progression would take us to around 700 crore of March exit run rate in March 24. And now we're adding a little bit more infrastructure. So we're adding around 75 physical location. We're entering 2 new states, which is UP, 3 new states, UP, MP, and Andhra. And hopefully by first quarter, this run rate should increase to around 900 to 1,000 odd crore. So theoretically, we should be at around 18 to 19 to 20,000 odd crore by end of next year. But more importantly, I think so, the reason why a company like ours have been able to get to that scale, because we have changed the spectrum of lending by NBFCs in India by being the prominent and more forceful partner to the large banks, both public sector and private sector. And our AUM, or the gross disbursement, 50% being now co-lended by the bank, is a game changer for not just for us, for the entire industry. So gone the days, or I think so in next 1 year or so, you will see that the NBFC's perennial problem of how to fund their asset and how to get the liability is massively getting solved. So the trust institution, which are the bank, which are the owners of the liability and the public money, and that power is now getting translated to us and getting translated to millions and millions of small businesses in India.
So tell me, what will your mix look like by FY25 if you could break it down between secured and unsecured book?
So first and foremost, I think so we don't differentiate customer and obviously the market looks secured and unsecured. We look at cash flow of the customer, which comes from this this data design of GST banking and bureau, and we are doing a lot more other than. The collateral actually only defines the tenor and the pricing. But we also believe that there is a conventional wisdom in what we call yield to loss ratio curve. If you lend to a customer, which is a secured borrower at say 11%, you'll have a 0.25% loss. If you lend a customer at 40%, obviously you'll have a 8 to 10% loss. And that's why our distribution and asset engine create that mix. We want to maintain the blend of 70% of secured asset and 30% of what we call the business loan. But I must remind you that all of our business loan, a majority of that are also guaranteed by CGTMSE. So 75% of our unsecured loan are guaranteed by the credit guaranteed trust. So to some extent, they are also quasi-secured. Within that band of 70% secured, we have secured by property as collateral, we have secured by machinery as collateral, we have micro enterprises, micro secured loan, we have supply chain finances, where then some sort of support from the anchors. And then we have what we call the channel, which is our Grow Extreme platform, where we have 75 plus partner, wherein there is some form of credit enhancement coming from the partner. So I think so we have created a very, I won't say complex, but very diversified mix of how do we maintain and sustainable basis a less than 2% credit cost. And that's a function of selection of customer type, selection of sector, subsector, and also construct of our portfolio.
What's the outlook then, Mr. Nath, when it comes to the overall asset quality trends as well that you're seeing in co-lending and the partnership lending model?
So co-lending has two parts, ma'am. One is what we do with the banks on the liability side, and what we do with other small NBFC and fintech on the asset side. So, so our asset block, whether that is being lent by us or that is being co-lent by banks, there's no difference because they are neutral to that. Banks is just a partner to fund the end customer. The trend which we are seeing from the which is roughly around 20%, 15% of our business with these multiple small NBFCs and fintech with whom we do the business. Obviously, that is very difficult to find the trend. Every partner has a different sub-segment, but broadly speaking, we are seeing much more improved, credit profile and collection profile vis-a-vis say 1.5 years back. And there actually, surprisingly, we are seeing some of the new generation, this is revenue-based financing, merchant lending, actually doing fairly well, which otherwise conventionally we have all seen or believed that they are fairly risky. But you have to be very calibrated because because when there is a lending without collateral, you can predict the default ratio for next 12 months, but you can't predict default for next 24 months. And that's where the collateral starts playing a role.
Sachita, one quick question. What is the sensitivity if your loan book, by all these measures which you're talking about, goes up 2-3 times in the next say 6 to 7 quarters? How much does it actually translate to profitability improvement? How is does the profitability increase in the same measure or slightly higher?
No, actually, that's fairly unique. I think so. I don't understand capital market, or I understand it very, very little. But I think so. The operating leverage, as you say, that this company started with 1,000 crore of capital. It built all of its OPEX upfront, and now starting April 23, most of our OPEX came to freeze, and that AUM started growing. And that's why if you look at our bottom line, is actually had a multiplier impact. So in 2022, we had a 7 crore PAT. In 23, we had 40 crore PAT. In Q1 this year, we had 25 odd crore, and we have guided the market where we should be in the range of 120 to 130 crore. And I'm fairly confident that next year, this bottom line should be nearly doubling from where we are. Because now our incremental OPEX is very limited. So for example, when I add 75 or 100 physical location for more micro enterprise business, the cost of that incremental OPEX is not more than say 5 to 6 lakh rupees per branch. But the return profile of that, because a 20% secured yield business, it takes 12 months time to 15 months time to break even, is fairly significant. So the operating leverage or OPEX to income ratio now would significantly improve. So we were last year at 71%. Our target is to bring our income OPEX ratio to 45% and remain at that level for next few years.
Excellent. Thanks very much for your time and of course telling the roadmap of the company from here on as well. So the gist is that when the loan book actually grows even further from here on, the profitability impact is a multiplier of that. That's something to watch out for. Now Vineet Bolinshkar is here, the stock picker from Ventura, and he has come out with a very interesting note on a company which is in focus for multiple reasons. Well, you heard it first here on ET Now, and now the story is progressing. Religare Enterprises is a company in focus. Vineet has come out with a note out there. The trigger, of course, is that the Burmans have launched an open offer out there. Vineet, what a coincidence we had you today. And this morning, one of the pink papers also says that the current management believes that the price at which open offer has been launched is way lower than the intrinsic price, and they are seeking an independent valuation exercise for that. Your note also says that the valuation could be at least double if you take into account the underlying assets. How deep have you really looked at the business model there?
So we spent quite some time before we published this note, understanding the various nuances going around with it. So what we believe is that after the one-time settlement that they achieved with the banks in March 2023, the company is now veritably placed, unleashed, and it can absolutely grow the way it wants. If you see the, I will come to the main talking point a little later, but if you look at the various other businesses, which are the affordable housing, if you talk of the SME lending and the broking business, they're a paltry, 700 crores kind of, less than 1,000 crores kind of current AUM that is there on the books. And considering the talent that is there in the company, the erstwhile business that it used to do. For example, in the SME lending, they used to do 20,000 crores. Today, their book is down to, very paltry 1,500 crores. So we believe that going ahead, they already have that, technology backbone in place. This business can really, really spur on growth because they don't need to raise capital in the short term, as they have got fairly high capital adequacy. So this same thing can be initiated in the affordable housing and the SME lending, and we've had very, very conservative targets of doubling from current levels for the next 3 years. Now, if you look at the insurance business, they have been profitable for the last since 2009. Their total expense ratio is far lower than the competition at about 92.5. Their solvency ratio at 1.8 is significantly higher than the regulatory 1.5. And the company has grown there at a blitzkrieg 45% CAGR over the last 3 years to around 4,500 crores of gross written premium. And from here, we expect it to grow to 8,000, given that the tailwinds for the health insurance sector are very, very robust. We think that, we value this business at the entire business on a SOTP basis at about 471 odd rupees, which is nearly doubling from the current levels of over 235. Coming to the fact that the Burmans have taken a stake around these levels and made an open offer, and with the management coming in with a, sentimental note saying that, the valuations are less and they've asked an independent valuation report, I think it calls for interesting times for this company, and the price should do very well in the coming few days.
Vineet, I wanted to also get in your thoughts then on the overall valuations in terms of what Religare commands at about 2.7 times FY24 price to book. How are you looking at the overall valuation metric in light of this?
So, let's look at it on a PE basis, because bulk of the valuation is coming from the insurance business, which is generally valued on the premium basis. This business is available to you at about the entire conglomerate is available to you at 11.5 times 2 years forward. I believe that this should reach somewhere in the range of around 40, because it is one of the most attractive insurance plays out there in the most fastest growing part of the insurance vertical also. And, it's quite high there on the profitability metric. So I think, a conservative estimate about 25 times 26 numbers is what we are looking at.
Vineet, I want to go back to the commentary which the Burmans gave at the time of launching an open offer. They said that they are keen and they aim to make Religare Enterprises as a full-scale financial services platform. Now, we all know that they have a very successful health insurance, but other businesses are relatively smaller. How much scope do you see the financial muscle of the Burmans and the the managerial strength as well? Next 2 to 3 year period, can they really scale this business up to a certain size? Because all of these businesses, NBFC, broking, asset management, there are industry tailwinds which exist. Somebody needs to scale it up.
So, at its peak, the SME lending business was a 20,000 crore run rate. Out of that 4,000 crores was a questionable lending. So they were doing 16,000 crores vanilla lending, which was built from the ground up, right? And today they're at about 1,000, around those levels, right? So that purely came because the RBI put a cap on their lending. Now, with the advent of health insurance, and they have got a very large period of cooling period, during which a lot of work has gone into the back end in order to build out a very, very strong technological platform which can take on the growth. So, you have to appreciate a few things. Earlier, their ticket sizes were very large, right? They would be 3 crores to 5 crores would have been the smallest ticket size. But in today's times, I think the ticket sizes have come down become smaller, and you cannot use the same feet on street approach to garner your AUM book, and it's going to be more technology led. And I believe that is a route for which they have planned and which they will grow. Now, with the Burmans come in so Religare already had a very, very strong brand. Along with that, if the Burmans come in with their own brand, I think they are going to be able to together stitch a very veritable institution which will have the confidence and the standing of the Burmans that hey, we are there for any incremental capital that is required, and that will really help take this business off to another level.
We'll let you go on that one. Thanks so much for joining us for in-depth stock-specific analysis, which you keep doing time to time. We'll get you back for some other names as well. But we'll take a short break on that note and come back and take the sector and stock analysis forward on the other side of the break.